I want to welcome you to the 2024 New Hampshire Insurance Department Property and Casualty Market Symposium. My name is DJ Bettencourt. I have the pleasure of serving as the Commissioner of the New Hampshire Insurance Department. I want to take just a moment to introduce some members of the department here. I'm going to miss a few folks, but if we went through, everybody would be here all morning. And I do want to point out that we do have a hard stop at 11:30 this morning because some of our presenters have some flights to catch. I want to introduce Keith Nyan, our Deputy Commissioner. I saw him floating around here in the room someplace. James Fox, the head of our Property and Casualty Division. Christian Citarella, the Property and Casualty Actuary. And Doug Reese, who leads the Market Conduct Unit for our Property and Casualty Division. This is a bit of an experiment. I drew inspiration for this event from the annual hearing that we do every year on the cost drivers and things that are impacting the health insurance market. We do that every fall over at the University of New Hampshire School of Law. And I felt that given some of the unique dynamics that are playing out not only here in New Hampshire, but across the country and really the world with our property and casualty markets, that a gathering of this kind could be very beneficial, not only to those of you who are in industry, but also, of course, to the consumer. In everything we do here at the department, we do try to ensure that we are keeping a focus on the consumer. And unsurprisingly, one of the most frequent questions that we get is, why are my premiums going up? Why am I not able to get access to coverage that I've been able to get access to before? And of course, all of that speaks to the dynamics of this very interesting market that we're experiencing right now. I think there's a general consensus that the market is hard-ish. And obviously there are a number of reasons for that. And we're very, very fortunate this morning to have a number of experts who are going to be able to help us do a bit of a deeper dive and a bit of an analysis to help us understand what's going on and to help the consumer understand why what they're experiencing, what they are experiencing. And no, it's not just about greedy insurance companies. There are actual dynamics, there are actual things that need to be thought through, and hopefully we'll be able to get into that today. I want to take a moment to introduce our keynote speaker, Dr. Robert Hartwig, who is a Clinical Associate Professor of Finance and Director of the Risk and Uncertainty Management Center at the University of South Carolina Darla Moore School of Business. His research focuses on insurance markets and structures, risk management, pandemic risk, risk-bearing capital market instruments, the financing of technology risks, and venture capital in insurance markets. Prior to joining the Darla Moore School of Business, he was president and economist for the Insurance Information Institute in New York, and in prior positions worked for Swiss Re, the National Council on Compensation Insurance, and the United States Consumer Product Safety Commission. Dr. Hartwig has also served as an adjunct professor at Florida Atlantic University, and we are very pleased to have him here with us this morning. Thank you.
Thank you, Mr. Commissioner. Thank you very much. My pleasure to be here, and thank you all for turning out. It may seem odd to drag someone all the way up from South Carolina up here to Concord, New Hampshire, but I am dragged all over the country routinely, and I very much appreciate the opportunity to be here. And it's actually good to be up here knowing I am a native New Englander and spent the weekend at my parents' in Massachusetts driving up here this morning, so it was very, very good. But without any further ado, let me get into it. I'm going to spend about the first 30 minutes here running through at kind of a breakneck pace, kind of the state of the P&C insurance markets and many of the things that the Commissioner just mentioned. The markets are under pressure today. There are a lot of actual dynamics that are in place, and I'll be talking about essentially how we got here and where we're likely to be headed in this market, with a bit of a focus on New Hampshire markets, of course. But overall, I'll be kind of focusing on the industry's major pressure points today. So I'll talk about the relatively poor underwriting performance we've seen in the P&C side over the past several years. A lot of that is driven by what's been happening on the cat loss side, catastrophe losses, reinsurance markets, which have been particularly hard, and then issues of capital and capacity in the marketplace, which really limits what insurers and how much they can actually underwrite. There are some economic pressure points out there today related to things like the interest rate environment, and at least until interest rates recently began to go up, volatility in the investment environment, things like this. And then I'll be talking about one of the major issues for the industry, and that is really the principal driver in many instances is the issue of inflation, which is still working its way, kind of a pig through a python type of situation in P&C insurance markets today. And we'll show real hard data about what's happened to claim severities, focusing primarily in personal auto space, but the same thing's going on in commercial auto, some property lines, and what's going on with the loss ratios there, so you can get a sense for that. And I'll have some actual New Hampshire related information and benchmark that against the U.S. as well. And I'll give you a sense of where inflation is headed. By the way, this presentation is posted to my website already. So if you cannot keep up with me, that's what my students tell me, that you can go to USC Risk Center, all one word, uscriskcenter.com/presentations, and you will see this presentation is already there. Okay, and we'll be, and I'll conclude on some issues related to abuse of the legal system, which is another driver that's out there as well. So we kind of have some underwriting concerns, part of that driven by cats. We have inflation, some other economic concerns, and then we've got abuse of the legal system. All of these are factoring into the hard or hardish kind of conditions that the commissioner already referred to. Okay, so where are we in this industry today? Many people think that the property casualty insurance industry is kind of just immense business that's just always rolling in dough and has an extraordinarily high, say, return on equity. In fact, we just got in final numbers for 2023. And what we saw is last year, 2023, we had a $38.4 billion underwriting loss, and that was about $7.5 billion worse than in 2022. Yes, premiums did go up in terms of premiums earned by about 10%, but unfortunately, losses and loss adjustment expenses went up 12%. So that's a prescription for deteriorating underwriting performance, which is exactly what happened. So last year, the combined ratio was even higher than I thought it would. AM Best just came out last week, and they said it's 103.7. I was going with about 103.4. And about 8 points of that was due to cats, and it would be even worse if you kind of backed out favorable reserve development there. It would be above 104. And so a couple of other things. So net income looks like it was up tremendously. Okay, we'll go back. This is the, okay. But it actually wasn't. There was one strange transaction from a Berkshire Hathaway company that kind of generated the majority of the profit in the industry last year, kind of a huge realization of capital gains. So in reality, the industry's net income after taxes actually fell by about 1% last year. When you adjust that out, and the industry's capacity, its surplus, policyholder surplus, we ended at just over $1 trillion, but that's still down about 2.5% from a couple of years ago. So, and we have a lot more in the way of insurable exposures today because of inflation. So there is a capacity issue in the industry that remains today. Okay, in terms of underwriting performance, here you can see sort of at the end, here's our 103.7. That came after a 103.1. So this was the worst year since 2017 in the industry. Okay, worst year since 2017. No question. And the second worst year since 2011. So that's important to keep in mind. So there was some underwriting distress here. Now this is kind of a busy chart, but I'll kind of break some of this down later on. But what I wanted you to focus on here, so we have about 5 years of history, 2019 through 2023 in terms of underwriting performance. And then a forecast for 2024. But there's a lot of pressure in the auto line. So you look at last year, the blue line is 2023, blue bar, almost 110 combined ratio in personal auto. That's off about 112 the year before. Commercial auto is not doing too well either. And then commercial multi-peril and homeowners, the property sensitive line. So homeowners last year, 111 combined. Okay, so you think about paying out $111 in loss and expense for every $100 you earn in premium. That's a prescription for a pretty bad year. And you got some other issues in some of the casualty related lines like med mal, but we won't really dwell on that too much. Across the country, in property lines in particular, this is pushing a lot of premium into the excess and surplus lines markets. A lot of this is being generated in places like Florida, California, okay, Texas, Colorado, places like that, and some other coastal areas. I don't think New Hampshire accounts for very much of this, but you may have observed yourself even some migration of premium in New Hampshire into the E&S markets. In terms of net income premiums, net income, what we have, so this is basically profit after tax. So as I mentioned, it looks like it was a wildly profitable year So yes, I adjusted this one. I had just recently adjusted it. So we're at about $38.6 billion. That's down a few percent from 2022 in the industry. That's adjusting out that unusual number from the Berkshire Hathaway. Like I said, I just got those numbers on Friday, so it's the first time I've actually displayed these. So you can see how the industry's profit after tax is down substantially from the prior several years. And inflation has a lot to do with that. If we look at the industry's return on equity, its ROE, we could see how it's kind of very volatile over the past almost 40 years here worth of data. And it bounces up and down from a large extent associated with cat-related activity. And then also economic events like the financial crisis. Interestingly enough, not much of an effect from COVID there other than to further depress interest rates, which kind of ate into industry's earnings. I have not adjusted this out yet because I haven't had a chance to work out the arithmetic. So the industry's ROE looks like it was close to 7% and went up, but it actually, when you adjust out that unusual transaction, it likely fell to somewhere around 5.7%. That would be my guess at this point. Now, the economic environment, I said that the economic environment is very, very important in terms of getting a sense of what happens to the property casualty insurance industry. We tend to think about it as a cyclical industry, but over the last 15 years or so, we've really become more joined at the hip with the overall economy in terms of our cycle, though that doesn't mean that there aren't sort of hard market and soft market elements there as well. So the industry, the overall U.S. economy last year avoided a recession, which is a great thing. And we're kind of moving along at a relatively modest pace of growth right now, maybe somewhere in the neighborhood of 2.5% GDP growth for the U.S. overall. Now, I do presentations like this all over the country, and it's a very different story in different parts of the country versus others. We have a lot of diversity in terms of how fast the economy is growing. So in a place like New Hampshire, we've got economic growth of 4.5% in the most recent data that we have. That's versus 4.9% for the U.S. overall. And you can see the darker blue states are the ones that are growing the fastest. So you see some in the south, and then kind of in the south central states, the mountain states area like that. So you tend to see the lighter blue states are kind of slower growing at this point in time. And the reason I bring this up is because when you think about how big the P&C pie is growing, when you think about opportunities for brokers, agents, those sorts of things, it's nice when the overall pie is growing rather than, companies and carriers just kind of taking business from one another. So in the slower growing states, it's a more difficult situation. In the faster growing states, we've got an enormous amount of new exposure, both in terms of property and casualty related exposures. But here, this chart shows kind of what I was hinting at, how joined at the hip the industry is with the overall economy. We've got direct written premium in blue, and we've got year over year change in GDP in orange, and you can see how tightly correlated these two things are with one another. So kind of so goes the economy, so goes the industry. That's very, very important these days. And so the good news about not having a recession, a year ago everybody predicted a recession. The good news that we're not having one is the fact that that pie is growing for the P&C insurance industry. It means more businesses, more homes, more vehicles, commercial exposures, payroll exposures, all of those things. And that's great news. Now, the biggest threat, not only for concern of consumers in small businesses and large businesses, but obviously the insurance industry, has been the issue of inflation. Consumers began to experience inflation in a significant way beginning in 2021, and that really peaked in 2022. In June of that year, the peak inflation rate was 9.1%. It's been coming down kind of in a zigzaggy fashion ever since then. 4.1% last year. The most recent number for January was 3.1%, and we'll get the new numbers for February, I believe, this week. But the prediction is that we'll be somewhere 2.6% or so. It might be slightly higher than that for 2024, and closer to 2.2% in 2025. So it takes a while to kind of get through this whole challenge associated with inflation. So this has created a number of issues related to rate adequacy, reserve adequacy and proper insurance to values across the industry. And the rate issue that we've heard consumers talk about, of course, is related to the rate adequacy. And also, to some extent, some consumers be confusing rate with they may have automatic adjustments on their limits, and there is some part of that as well. So it isn't just related to rate. The cost of rebuilding a home, for instance, in many parts of the country is materially higher than it was just a few years ago, and I'll kind of drill down to that in a minute. Now, the story of inflation since COVID was first related to energy prices, and you're seeing that element. These are the various major drivers of inflation. And this kind of a top part of the bar, the sort of blue part, that was energy. More recently, it's been things like food. And then now it's this gray part, which is what they describe as core services. This means services that we purchase except for energy, food and energy related services. So this is anything, for instance, travel would be a good example of that. And another one would be included in this actually is insurance is included in this. So that is considered a core service. And so if we drill down into this a little bit, for instance, the one that's captured headlines recently is this. These are not my numbers, these are the federal government numbers. So this is the Consumer Price Index component for personal auto, what they call motor vehicle insurance. So every one of these data points I've calculated here is a 12-month year-over-year change. Most recent numbers for January, and it shows that number was 20.6%. That's up from even December. And so that's catching the eye of consumers, okay, not surprisingly. So the cost of motor vehicle repairs motor vehicle insurance as the consumer sees it is up about 20%. The auto insurance component for the overall auto insurance accounts for about 2.8% of the overall consumer price index. So not a huge component, but nevertheless, people tend to see their renewal as kind of a large lump sum or maybe divided into monthly or quarterly or semi-annual payments. And it's really caught their eye recently. And so we'll talk about homeowners insurance in a minute, but just so you get a sense of what some of the drivers on homeowners insurance, which is up materially as well. I mentioned 111 combined ratio. That was due to a combination of increased severities from inflation-related issues, plus some issues related to cats, which has an impact on the frequency side also. But if you look at rebuilding costs, whether it's a home or whether it's a commercial structure, you could look at, okay, great, lumber prices are back down to earth, although they had more than doubled during some period of time. But everything from concrete to copper to asphalt shingles, for instance, this is a big problem in many parts of the country, up 40%. Gypsum, drywall issues, for instance, up 43%. Steel products, up 65%. For many of the major inputs, property inputs, the insurance industry is experiencing inflation, not the way that consumers experienced it in the All Items Consumer Price Index, which was 19% in the 3 years ending of December of last year. But oftentimes, many of the key inputs are up 2 to 3 times the overall rate of inflation. So inflation as experienced by property casualty insurers, there's no question, is much higher than has been experienced in the overall economy. And that explains some of the pressure we're seeing, particularly in the property and auto-related lines. Now, if we look at the overall cost of construction materials in the 3 years ended in December, what we see is those were up about 41%. The cost of getting people to do things like plumbers and contractors and so forth, that was up about 34%. And again, this compares to an increase of about 19.2% in the overall consumer price index from January of 2020, just when COVID began, or just before it began, to the end of last year. So this is what insurers, property casualty insurers, are seeing out there. It's a very intense form of inflation. We can only reflect it in rates with a significant lag, and that's exactly what's happening now. So whereas inflation has subsided in the broader economy, it's at its peak in the property casualty insurance industry today, at least in terms of passing it through to consumers and trying to fix those terrible underwriting numbers that we saw a moment ago. If we look at The auto side of the equation, so private passenger auto is the largest of all P&C lines. It's about 38% of all premiums written. And so here I'm drilling down into looking at the New Hampshire numbers in particular. Now, New Hampshire numbers, I will say, are more volatile than many other states and the U.S. overall because it's a relatively small state, okay? And so the trends don't necessarily come across as clearly here as they do in some other states or nationally. But what you do see across, for instance, this is bodily injury severity. And I'm going to go through a bunch of the coverage, several of the coverages right now. You see an almost continuous severity trend in blue. And you see frequency dropping, not surprisingly, rapidly during COVID. Literally, it was 4 years ago today when many universities and such, including mine, announced they were closing down. And so we saw a big frequency effect, but we continue to see severity continue to rise. This severity drop, which is through the year ended September 30th of last year, that's the most recent that we have. That's actually unusual. In most other states, that's up pretty substantially. So the severity trend is pronounced here in New Hampshire, but not quite as much as it is in other states. But you could see frequency still continuing to make its comeback after COVID. Now, when we look at property damage liability, a very clear severity trend here, up about 15% last year and about 20% the year before that. And again, frequency making its recovery from its big drop during COVID. Okay, so the pressure on insurers today is driven primarily by severity, and we're seeing frequency essentially get back to where it was prior to COVID. So I call that a normalization of frequency. In terms of collision, we see this across the country. Very sharp increase in collision. This is actually a collision collision severity in blue, and again, frequency making its comeback after its COVID. So after COVID, in many states, we actually saw an even stronger severity trend prior to COVID. Not so much in New Hampshire, but New Hampshire, like most other states, has seen a very sharp increase in collision severities. And then on the comprehensive side, which is often weather-driven, but nevertheless, all the repairs need to be done, and that's driven by inflation primarily. And we could see here very sharp increase, so about a 24% increase in collision claim severity last year. That's on top of, almost 10%, 12%, 14%. So you could see working its way through the system. This just absolutely swamps this sort of temporary decrease in frequencies that we saw during COVID. And we can see frequency has essentially gotten back to where it was beforehand. And in the Northeast, this is one area where you've not had some of the major cats that we've seen in some other parts of the country. You have had some wild weather, including floods and flooding of vehicles and such, that can contribute certainly to some of the increases we've seen here. Now, if we look in dollar terms, what has happened to collision claim severity here in New Hampshire? Well, by early 2023, so a year ago, hit an all-time record high of $5,423 in collision claim severity. That was up 61% from the full year 2019 figure, 61%. Okay, that's pretty substantial. And this is not atypical, okay? This is very similar to what we're seeing in most other states. The difference is that nationally and in many other states, the number is higher. So the collision claim number that reached its peak around the same period nationally was almost exactly $6,000. Okay, but in terms of percent increase, it's very similar. It's just that we're starting from a lower base here. Then it's come down a bit, and we're still up about 37% from where we were prior to COVID. So again, what consumers are seeing in rates are reflecting these, very high increases in severity. And if we take a look at what I did in this chart, I compared collision claim severity in New Hampshire versus the U.S. So you can see New Hampshire is consistently below the U.S., but what we see is a kind of a similar sort of increase over this period of time. And so here I'm comparing kind of annualized numbers, and I'm not using quarterly numbers. But the increase in New Hampshire since 2019 on an annual basis is about 45%. It's about 47% in the U.S. So very, very similar to what we've seen in terms of the same increases around the U.S. And again, this is consistent in almost every state that I'm in. Okay, and the collision loss ratios so this is just the loss ratio, not the combined ratio, in New Hampshire reached a peak of 99 at the end of 2022, got back into the 90, fell and then back into the 90s in late 2022 and 2023, and was close to 70 in the most recent numbers that we've seen. So that's not too different than what we saw prior to COVID. Maybe a little bit elevated, but it does bounce around in the state more than what you would see in other states, in part that's because it's a relatively small state. So let me move on from there, and what we could see is the collision loss ratios in personal auto. We could see what's happened here. So those peaked in late 2022 and are somewhere around 80 today, so those are elevated from what they were prior to COVID. And then liability loss ratios. This is bodily injury and property damage liability combined. Again, reached a peak of almost 99 in late 2022 and still around 85 today, or at least in the third quarter of last year. And so again, that's 6-7 points higher than it was prior to COVID. So there's still some pressure here. These loss ratios will come down both as inflation kind of slows and as rate catches up to these kind of underlying loss cost trends. So here are some of the drivers. If we look at the price index for new vehicles, what we could see that, this is a used cars and trucks. So this is very real for insurers. This peaked, this rose by a maximum of 52% in early 2022. It's still up. So the price of used cars and trucks is up about 38%. Through the end of 2023. That's exactly double the overall rate of inflation of 19%. So when insurers are out there replacing people's cars of like kind and quality, okay, with some used vehicle, it's costing them not 19% more, but like 38% more. Okay, if we look at new vehicles, we can see new vehicle prices are up about 21%. That's a bit more than the 19% for the overall CPI, but you could see those prices are not coming down. That's not insurers' faults. No one should have the expectation that most prices that rose during COVID or in the wake of COVID are going to come back down to where they were prior to COVID. Same thing when we look at motor vehicle parts and equipment. We can see that these are elevated, up about 22%. Through January, and that's just a bit above what we had seen in the overall economy, but nevertheless, this is having to be reflected, and these prices are not likely to come down a lot. Motor vehicle parts and equipment, and then we look at motor vehicle maintenance and repair. Okay, this is up too. Also, this is up about 32%. Okay, so 32%. So we're thinking about repair costs. Labor costs are a large part of this. Again, the overall inflation rate over the same period of time was about 20%. So seeing inflation far in excess of the overall pace. And what about, it just doesn't end there. Not only does it cost more to replace cars and fix cars, but while they're being fixed, they're taking longer to be fixed, and the cost of replacement vehicles paid for by insurers. That's what this is. This is replacement vehicles being used for the most part while your vehicle is being repaired. A lot of that paid for by insurers. That's up about 29%. Again, far and above the overall rate of inflation. And the good news here, very good news in New Hampshire, is that while the overall length of the time it takes to get a vehicle repaired was up by about 5.5 days since COVID, in New Hampshire you actually have, and it was up to about 18.7 days at its peak, 18.2 at the most recent data that we have. In New Hampshire, it's only about, New Hampshire, yeah, it's about 17.5 days. If you take your car over to Vermont, it's going to be under 16 days. So maybe that's a way to save a little time on the repair. So all you carriers out there, send the cars over there to New Hampshire to get repaired. Maybe Maine, that might fix things up a little bit too. Any rate, but it's much better than some other states that I've been in, like Georgia, where it's 20 days, things like this. And the other thing that happened after COVID that people don't pay much attention to is people got on the road and began to drive like maniacs and kill each other at rates that hadn't been seen in about 15 years. So we had about 43,000 people killed on the roads, a huge increase in 2021 and 22. We hadn't seen numbers like that since about 2005, 2006. Okay, that hopefully is beginning to improve a little bit now. We don't have final numbers for last year yet. On the commercial line side, the hard market there does continue, kind of the hardish conditions, not the hardest market we've ever seen, but it seems to be somewhat persistent. And it began certainly well before COVID. But COVID, well, the inflation afterwards kind of gave it legs. So this is the average renewal across all commercial lines. Most recent data we have is for third quarter of 2023, and that was up about 8%. So you can see it was between 8 and 9% for all of last year. That's actually below what it was in 2020. And what lines are leading the way? Perhaps not surprisingly, commercial property, kind of like homeowners, right? And commercial auto, kind of like personal auto. That's leading the way. The only major line showing significant decrease is workers' comp. That's been consistent with relatively strong underwriting results. But in recent quarters, commercial umbrella has actually been in lead position. And maybe about a year and a half ago, cyber was in the lead. But more commonly, what we have seen is some property, auto, and the commercial umbrella have been in the lead for the last several years in terms of pressure. And Wall Street has certainly been on a wild ride, and the second largest source of revenue for insurers, of course, is investment earnings. Investment earnings had been kind of flat or had fallen ever since the beginning of the financial crisis here as interest rates were pushed down and kept down. Eventually interest rates came up a little bit, but particularly in the wake of, as the Federal Reserve has begun to raise interest rates, investment earnings have come up substantially. This is essentially interest thrown off the bond portfolio for the most part. So some people may not like higher interest rates, but for large institutional investors like insurers, this is a beneficial thing, even more so for life insurers. I'm not here to talk about that. But this does help offset some of the losses that are occurring. And you can see what happened. This was one of the major pressure points. Your average consumer doesn't know this, certainly, and it's not the case that even many producers would be aware of that this is a pressure point. But you can see the average yield on the industry's portfolio was about 4.5% prior to the financial crisis, and then crashed as these bonds in the portfolio had to be replaced with very low yielding bonds. And in fact, by 2021, the yield on invested assets was about 2.6%. That was the lowest number the industry had seen since 1961. Okay, 60 years. All right, so that was a pressure point. So you can see what's happening now is the yield is beginning to recover, although whether it actually get this high depends on the pace of how the Federal Reserve adjusts interest rates. So we may not get back to where we were prior to the financial crisis, but maybe some facsimile thereof. A couple of final things here. Capital and capacity. I mentioned this is a pressure point. We measure capacity in this industry, as you know, by the industry's policyholder surplus, essentially the difference between our assets and our liabilities. That reached an all-time record high and surpassed $1 trillion for the first time at year-end 2021, about $1.1 trillion. Fell by about 7% in 2022 as the markets fell. And so the assets are marked to market, and so we had to recognize that. Came back a bit in 2023, so just above $1 trillion. But we're still below, and even the expectation for 2024 is that we'll still be somewhat below where we were in 2021. So the industry is capacity constrained. So the economy is growing. We've got pretty substantial increase in insured values all around the country. And this capacity issue is mirrored. This is the U.S. property casualty insurers. On a global basis, when we think about reinsurers, we're seeing the same thing. Capacity in the reinsurance markets was constrained fell in 2022. It was down about 12%. And even insurers that are domiciled here in New Hampshire compete in the global market for capital with insurers all around the globe. It's the dominant companies out there. You think of the Swiss Re's and the Munich Re's and the Lloyd's and all of these. Almost the vast majority of this capital comes from abroad. And so we're competing in that pool. And the same problems with inflation and cats have been happening around the world. And this has pushed up reinsurance prices. So reinsurance markets have not been hardish, they've definitely been hard, okay? We saw as of 1/1/23, for instance, reinsurance prices here in the U.S. property cat was up about 35%. 1/1 of this year was up about 5%. So some moderation is underway. But this is the kind of the longest sustained increase in reinsurance pricing relating to property that we have seen. Really, maybe either in the period around Katrina or the period post 9/11. So a very broad-based hard market, but there are some signs in reinsurance that things are easing a bit there. Although on the cat loss side, it's still an issue. And you can see that the last several years have been some of the most costly in history in terms of insured cat losses, even after you adjust for inflation. And about 50 billion, this is still an estimate, but about 50 to, it could be as high as 60 billion for last year. I don't have complete final numbers yet. But this decade is off to a very kind of ominous beginning in terms of cat losses. And this is how you get to 111 combined in homeowners and something similar in commercial multi-peril, things like that. Unrelenting pressure in terms of cats. And so we've had a couple of, this is the top 22 most costly insurance disasters of all time in the U.S. Katrina still leads the way, but it almost ceded the crown to Hurricane Ian in 2022. And we've got some other events. The yellow are the more recent events, Ida, a few things like that. So, but we got a combination of tropical events. We've got wildfires, only one earthquake in here, and 9/11, and we've been adding a lot of new events, unfortunately. And this is what last year's billion-dollar disasters look like. This is $1 billion in economic loss. The last chart was insured losses. And what we see is there was a huge concentration. So a lot of the property losses last year, they were heavily concentrated in the Midwest. Tornadoes, hail events, those kinds of things, although you had some severe flooding events up here in the Northeast. And that's what you're seeing up in this area, as well as a cold wave in early of last year. So all of these produced $1 billion or more in economic losses. We were spared any major hurricanes last year, which was amazing. The last item is the issue of abuse of the legal system. And many people don't have a good sense of this either. Rising litigation costs may be invisible to most consumers, but in fact they act as a tax. And it's a tax whose cost has to be passed along, both by the businesses that are having to pay out these large awards and the insurers that oftentimes are the ultimate payer of much of this. And so, when I'm asked to explain this, I talk about out there in society today, some people talk about social inflation. When we talk about abuse of the legal system, it has many different causes. Increasing propensity to sue, large jury awards, courts increasingly favoring plaintiffs, general distrust of large corporations in the field they need to be punished, third-party litigation funding, you may have heard about that. You can invest in lawsuits nowadays, aggressive plaintiff bar advertising, and these kinds of. By the way, I was in Vermont last summer and happened to notice, we're in South Carolina, about every 100 yards there's a trial lawyer billboard, okay? And if you're in an accident, you just take out your phone and you just dial the same number 7 times in a row and you'll get a trial lawyer on the other end. Do you allow billboards in this state? In New Hampshire also? You do allow them, okay, but you don't completely destroy the sides of the roads the way they do in the Southeast, things like that. And in Vermont, they're banned. I found that out. I said, I didn't see a single trial lawyer ad coming all the way up here to Burlington. And they said, that's because we don't allow billboards. That would be a great law to pass nationally, because you can't argue that, you can't say that those really beautify the environment. But average jury awards, kind of going up fairly sharply. And when we talk about very large jury awards, so-called nuclear verdicts, that's a term we get from the U.S. Chamber of Commerce, we can see that whether we're talking about, this would be generally commercial auto in purple, we could see that the average size, for instance, of your typical, of your nuclear verdicts in commercial auto, this is the most recent data we have, but in 2010 from up to 2019, an increase of about 63%, from about 15 million to about 25 billion. And we see this whether it's a product liability or we see it in other areas as well. And I'll move along from there. And so there is a real cost to the economy and to consumers. If you look at total tort costs in the economy today, or again, in the most recent data we have for 2020, $443 billion. That's about 3.2% of GDP, up from about 1.9% of GDP This breaks down to about $290 billion of this in the commercial liability segment and about $150 billion in the personal liability segment. This has got to be paid for somehow, okay? So this ultimately is a pass-through to consumers. Okay, ultimately, insurers are working hard to try to root out some of these fraud and abuse issues that exist, but this is far beyond the ability of the property casualty insurance industry itself to get its arms around. Okay, this is called, in places like South Carolina, Georgia, Florida, the legislature itself has been captured by the trial bar. It is run by the trial lawyer for the benefits of the trial lawyers. Okay, and so that is a huge problem to try to overcome. And so we could see, if you drill it down to the average consumer, if there's a message to take the consumer, is that it's that the cost, the tort tax, the cost that you are bearing per household has risen by about a third from 2016 to 2020 to $3,620 or so from about $2,800 in 2016. And those costs certainly are continuing to increase. And we can drill down in some other areas. There's some actuarial estimates. I won't run through all of them here, but it's estimated that in commercial auto, about $4 billion annually now can be associated with these kind of social inflation type effects, apart from, say, traditional economic inflation. And there are some other charts also that are in some of my presentations. If you want to download those, you could see that stuff. But the good news here is that the industry through all of this has remained strong, stable, sound, and secure, despite the record cats, despite the trial lawyers, all these things. The industry continues to make good on its obligations to consumers all across the country, despite the economic environment. The good news is the economy doesn't look like it's going to crater, so the industry will continue to grow and be able to provide capacity over time as the economy continues to grow. And those higher interest rates do provide some additional revenue for the industry. We don't know how long that will persist. Inflationary pressures are now on the downswing, but again, we're kind of that pig through the python. We're part way there, but not all the way there yet. And abuse of the legal system remains a very significant problem. So again, this presentation and many others you can download here on my website if you go to the presentations page. So my understanding is we were going to kind of stop there and take a little break for a little while, and then we're going on to the panel, right? Okay, great. Okay, thank you.
That was wonderful.
Thanks.
Really insightful presentation. Appreciate it very much. So yes, we're going to take about a 5-minute-ish break. Then we're going to come back and do the second half of today's presentation, a panel. So we'll see y'all in a couple of minutes. All right, we're going to get started. As I said, I want to make sure that we have plenty of time. We do have that hard stop at 11:30. As I mentioned, this portion of the event will be our panel discussion and Q&A. I would note that we obviously have a number of folks here in the room, but we also have a healthy number of folks who have joined us online. And so we'll obviously encourage them to feel free to ask questions. They can use the chat feature, and AJ will make sure that we're able to get their questions heard and answered. So we had a great presentation from Dr. Hartwig, and he's been kind enough to join us here on the panel as well. Joining him is Christian Citarella, who, as I mentioned, is the Chief Property and Casualty Actuary here at the New Hampshire Insurance Department. Next to him is a man who here in New Hampshire needs no introduction, George Roussos from Reno. And then next to him is Lee Dowgiewicz, AIC President and CEO, Co-operative Insurance Companies. Thank you all very, very much. So obviously you all had the opportunity to hear Dr. Hartwig's presentation, but I did want to see if there were other perspectives in terms of what are the causes of what consumers are experiencing, appreciating that each line is different. What are some of the common denominators in terms of what's impacting the market and ultimately driving premiums for consumers? And Christian, I'll start with you.
Sure. Well, as you're aware from Dr. Hartwig's presentation, there are stressors to the insurance market, and when we talk about the market, there are many markets within that insurance area. And so, we were talking mostly about auto. In New Hampshire, where you're certainly seeing a significant uptick in rate, and which is indicative of a hard market on the homeowner side. In addition to also uptick in rate, but we're also seeing kind of a more selective homeowners underwriting criteria. We're definitely getting some changes to underwriting guidelines and some conversations there. We're seeing carriers be more selective in writing, so indications of that hard market.
So, Christian, if I might, before I let you off the hook, opportunity for the consumers to better appreciate what the role of the department is in terms of rates and premiums. I think that there is a misconception that we have the ability to disallow or otherwise prevent companies from being able to ask for rate. So explain what our role in that process is.
Right. So it comes down to RSA 412, 15, and 16. RSA 412, 15 says that insurance carriers cannot have inadequate or unfairly discriminatory rates and then in a competitive market, we do not have a statute that prohibits excessive rate in the market, provided that the insurer, and this goes to that next statute, RSA 412.16, as long as the insurer files those rate changes and with support and actuarial justification for that rate change, and that's what I'm seeing. I'm seeing carriers produce, and Dr. Hartwig's presentation showed it clearly, that there is need for rate. And so if there's need for rate, it behooves carriers to take that rate, because the consumer benefits from a well-financed and well-capitalized market. And so they need to rest assured that there's going to be availability on the back end for when claims occur.
Perfect. I appreciate that, Christian. So the takeaway there is we can't disallow a rate increase just because, in your opinion, you don't like it.
Right. I will have communication. I mean, and it's not whether I like it or don't like it. It's it is sometimes I'm the bearer of bad news, and it's not news that the consumer isn't aware of when we break it down, as Dr. Hartwig did.
Hopefully our legislative friends are hearing this as well. George, in addition to obviously providing us with your perspective on what are some of the cost drivers that you're seeing, experiencing, analyzing, I'd like you to take an opportunity to also talk about some of the challenges that we've seen here in what Dr. Hartwig has called social inflation. And obviously some of those litigious challenges that we're encountering here with this particular legislative session.
Sure, and that's pretty timely with what's going on in the legislature right now on some bills. And I listening to Dr. Hartwig was just wishing that he was speaking to a larger audience of 424 legislators, for example, who really don't even have much, or if any, idea what a hard market is. And I know, Commissioner, we met with legislative leaders a couple of months ago to talk in that case about condominium master policy insurance and complaints from agents that it was hard to find, and there was talk about what do we do about it. And it was an eye-opener, I think, for legislative leaders to hear what this market was and what a mistake it would be to take action to involve government in either requiring people to write or otherwise acting, and it was, and we went back and showed them that there was some market. Yeah, it's harder to find. It costs more money, but as long as there's a competitive market, as Christian mentions, government is a lot better off I'm speaking to the choir here in this group, but it's far worse to get involved. And I'd add one thing in thinking about this presentation today that I think makes New Hampshire special. In addition to the attitude that Christian mentioned, which the department's view to encourage competition and free markets to the extent possible is the best way to benefit consumers. And unlike states around us, many states in the country, New Hampshire has not adopted market assistance plans for anything other than the workers' comp and auto, and there have been pressures to do that. And I was thinking back to times when markets have been tough and where they were handled. There was some pressure to come up with an involuntary market plan to take care of those markets. About 30 years ago was probably the most serious interest. And what happened then was the insurance commissioner brought insurance companies in, described the difficulty, particularly at that time in liquor liability, municipal insurance, and daycare. And companies voluntarily stepped in, mostly domestic companies, and said, we will write, this company will pick up liquor liability risks and the other risks. And it worked. We got through the hard market without imposing a governmental plan that once in is awfully hard to get rid of.
No, George, I think you raise a critical point there, which is obviously this is a property and casualty symposium, but there is a saying in the healthcare world that first you want to do no harm. And I think that we've seen some of the consequences of some of that drastic action in other states. You know, the state regulators who have succumbed to difficult conversations and have done things like trying to mandate companies offer certain types of coverages in order to write in that state. And the consequence has been that the companies have said, well, we'll pull out of the state entirely. And that's obviously not healthy for markets. I always remind folks that New Hampshire represents less than 0.5% of the total written premium in America. We need companies here. And if they were to pull out, they'd probably be able to make up that lost revenue just by looking through the couch cushions. And in terms of something in the flavor of a fair plan, I think here in New Hampshire we have a unique perspective. To borrow a phrase, we can see Massachusetts from our house. And when Massachusetts implemented its FAIR plan, the intention was that it was going to be the plan of last resort. And as things have played out, of course, it has in many respects become the plan of first resort, which again is very, very disruptive to the market and not something that's beneficial to the consumer. Lee, I want to give you the opportunity to share what you see are trends and pressure points in the market.
Sure. I want to first thank the Insurance Department in New Hampshire and yourself, Commissioner. I don't think it's recognized probably how many filings are coming through your department right now. To Dr. Hartwig's slides, the loss experience is quite poor, especially in personal lines. And that is necessitating almost every insurance company, I would think, is trying to put some sort of filing. And this is not going to stop. Like, this is going to continue to be the rigor for a bit. So that effort to review that filing and work with the carrier to actually get it in place there's a lot of hours taken to get to that point. And, multiply that by the number of carriers doing business in the state. I just want to express my appreciation for that.
Sure.
I wanted to talk about commercial for a second, but I think personal lines is really the bigger topic. So one thing that I would point out to people, and especially you mentioned the condo master policy, George. So facultative reinsurance is an element that's part of reinsurance. Insurance carriers buy treaty reinsurance. We buy facultative reinsurance to cover the largest risk. And those facultative markets used to be the tip of the spear. They used to be the people, when a risk was being placed, that you kind of knew if the market was getting hard, soft, medium, by how much limit needed to be purchased facultatively. And it does seem, following the treaty reinsurers' coattails, and Dr. Hartwig showed a 35% overall increase, and Co-operative insurance did pay a 35% increase last year in our reinsurance costs. The facultative market now seems to be rearing their head and trying to make sure they're getting an adequate rate. And how that plays out is on larger property risks, especially in protection classes that are not as great. So let's say 9 and 10. So if you're thinking about a ski town with a larger condo complex where the insurance carrier is saying, hey, I only want to retain X amount of risk and I lay off some of the facultative market, they're going to pay a lot more for that facultative reinsurance. So it's going to show up in their overall costs, which they're going to end up having to pass along. Or
in the worst case scenario, basically just step back and say, should we be doing this anymore? And I know that's playing out. It's playing out. I would have thought it would have played out a year ago or 2 years ago, but it actually seems to be becoming more poignant right now. Through the end of the year, going into this year, end of 2023, going into this year, it's been a big focus of ours. Focusing on personal lines. So I went over to get something to drink a minute ago, and after listening to Dr. Hartwig, I was looking for vodka to put in this orange juice. It's like, wow, yeah, and I don't disagree with anything he said. I guess I would just try to share our own experience as a company and personal auto as a focus. So through the end of the year, well, let's start with through the end of February, and then I'm going to go back to last year. So through the end of February, our auto loss ratio, I'm not talking combined ratio, I'm just talking loss ratio, pure loss ratio, is a 97% loss ratio. Through the end of the year, it's 82 loss ratio. We took a rate increase at the end of the year. Now, it was only in effect from September on, but our loss ratio deteriorated with the rate increase. So the pig through the python analogy, like, I think we're in the esophagus area. We're still got a long bit of digestion to work through here. We are still seeing increased costs when it comes to personal auto in particular. We do write commercial auto. Commercial auto tends to perform a little bit better for us more than the industry does. We know we have to continue to make change, and we're not trying to overcook it, right? I don't want to be charging more than the marketplace should be able to bear. But relative to the loss ratios I just gave you, and like taking a rate increase is having no positive effect for the company, I kind of have a feeling this is the way this is going to go for a while. When's it going to end? I get that question all the time from agents. When I read insurance periodicals, especially lately, it seems like people are writing about this ending in 2024, but I don't think the writers think through the premium has to be earned out, and we're evaluating all the time. And in Co-op's case, we only write annual policies, where other carriers might write 6-month policies and take a rate increase more frequently. We don't have that luxury. It's not what we're doing. We're more into this for the long haul, and I think that's where the 12-month policy plays in. This is probably more like 2025, 2026 before things start to level out. And when I say level out, I am not saying drop, because I do think when I have this kind of conversation with people that think, well, prices are going to come down. No, I don't think so. Like the reinsurers with their 35% increase and another 5% this past year, we actually had a little bit more than the 5% this last year. They're not going to all of a sudden soften their costs. They're looking at a new normal. There will be a time where it starts to decrease, but we aren't there yet. They're the backers of the industry. They've lost an awful lot of money over a relatively short period of time. They did not make it up in investment income. This is all they can do. They can raise the rates of the primary insurance company. So the last thing I'll talk about is home. I do think home is one of those areas where it's not just about rate, right? You're going to have to find those key characteristics that drive for your portfolio, better loss experience, and try to focus on those risk characteristics to drive that business to you. This isn't what the industry did years ago, but it's definitely where the industry is today. We use outside analytic firms to help us get a better sense of what it is that drives our loss experience specifically, and we try to, guide our rates to be more aggressive towards those that presumably over time will have better loss.
Dr. Hartwig, obviously your presentation focused a lot on the causes and the stresses that we're seeing in the market. Certainly feel free to add on to anything you've heard. But one thing I think from a consumer perspective is I think they can appreciate things like severity increasing, frequency increasing, catastrophic losses, that social inflation you spoke of. But I do think that one of the things that is truly not understood, at least certainly not in any comprehensive way by the general public, is the concept of reinsurance. So maybe explain that a little bit for consumers to understand how that all comes into play.
Right. Well, I have the benefit of teaching an intro class in risk management and insurance. So on the first day when I talk about reinsurance, I talk about it this way. I say it's insurance for insurance companies. And when you think about an insurance company itself, your insurer is writing your auto policy and thousands of other people's auto policies, maybe in New Hampshire and maybe across the country. And so what it's doing is it's pooling risk. And so it's spreading the losses of few across the premiums that are collected from the many. And so now, as it turns out, insurers themselves face this issue of, let's say, a particularly large catastrophe happens in their market area, and they might wind up with many homes or vehicles or what have you being damaged simultaneously. And so what's going to happen is there are going to be times when an insurer finds itself on the hook for a very large aggregated amount of claims in a very short period of time. It would be very, very expensive for an insurer to keep all that money in the bank, so to speak, under their own account, 24/7, 365 forever. And the way that they manage that is they themselves buy insurance, and they buy it from reinsurance companies. As I think as everybody in this room knows, but again, the average consumer has never heard of a reinsurance company. And so they are absolutely essential. Effectively, there's no property casualty insurer, no life insurer, no health insurer for that matter, that doesn't buy reinsurance. And the way that the reinsurance markets work, as I mentioned in my presentation, is essentially there's a global pool of capital out there that is available to reinsure just about every insurer on the planet. And whether you're a company domiciled in New Hampshire or a company domiciled in Germany or a company domiciled in Japan, you are going to have to purchase reinsurance, and you're by and large going to be purchasing it from the same group of companies. I worked for a company called Swiss Re, who at that time claimed they were the largest, and Munich Re and Swiss Re fight it out, and they're named after places in Europe, and they're named after places in Asia, and things like this. Warren Buffett has one, but the majority of the money's coming from abroad. And even Warren Buffett himself puts those funds out to the highest bidder. And so the reinsurers around the world were hit with inflation around the world. They were hit with record cat losses around the world, and that led to kind of a decline in the amount of capital they had as well. So just on a very aggregated macro global scale, they were seeing the exact same thing that insurers right here in New Hampshire were seeing. They were passing along their costs also. And so that drove up the cost for the reinsurance cost for literally every insurance company in America. And fortunately, that does seem to be ebbing to some extent as of 1/1/24. That can change, though, because the United States is the global leader in terms of insured catastrophe losses. And last year was not as bad as it could have been, so there's a little bit of relief. We've got some recovery in the capital markets in terms of resuscitation of asset values and things like this. The rate is working its way through the system. But I would say the reinsurance markets are on the road to recovery, but kind of that recovery is still a bit fragile.
I think a lot of us in New Hampshire like to think that we are the captains of our own destiny. And unfortunately, in the insurance industry, we are all connected both nationally and internationally. And those macro issues that you talk about do have an impact right here for the New Hampshire consumer.
They do.
Christian, you and I were talking the other day about how it seems that when you look at the global American economy, we kind of have this cycle where we go through a recession of sorts about every 8 years or so. And it raises the question, is this hard-ish market in insurance going to be the new trend, or is this a blip? And I appreciate the X factor and difficulty in answering that question is the worldwide pandemic.
Right.
It kind of throws everything off. But from your perspective, what do you see?
What's going to happen in the future is very, very difficult, although actuaries do need to at least give an educated guess at times. But
just give us a couple of stocks that are near.
Let's start there.
It's a whole different area, I think it's important to look at each market individually. I think there are different stressors and different, causes, that kind of shape the cycle, and they're kind of unique to different areas. Just in the two we're talking about here, and what I'm seeing from filings recently, both the personal auto and homeowners over the last 2 years or so, we've seen significant uptick in rate filings, increases in rate. Auto, they were more significant, but as far as the numbers that came in, they were comparable. And so, as Lee was mentioning, they were coming in kind of fast and furiously. The homeowners have started to kind of tick back a little bit. The homeowners rate filings that I'm seeing, they're not as frequent. I've dealt with fewer in the first 2+ months of the year than I did a year ago. Where auto, to what Lee was saying, I was surprised. I was expecting it to soften, ease up a bit in just the number of filings, but they're right on pace as to where they were a year ago, and I'm trying to understand why that's different, and I suspect it had, and I think Dr. Hartwig mentioned this a little bit, and when you're dealing with homeowners market and the homeowners insurance is about rebuilding the home, basically, right? Damage to the home, and it is more in line with the costs associated with replacing the home, and as yes, there was a significant inflation in the area of raw materials and whatnot, but that is going. There's reason to believe that that's going to plateau, right? At least, if not come down. The cost of labor is, there was an uptick in the cost of labor, and that's a question I have for Dr. Hartwig as to where wages are going and how, the lag between wages and inflation and how that affects other areas. But it is reasonable to assume that homeowners has some kind of caps there, some restraint. Where auto, there are just many factors that are playing, and as Lee mentioned, I don't see the kind of the downside to auto coming in the near future, unfortunately. We talk about, it appears as if we've kind of gotten through the problem of the supply chain that came with the pandemic, right? And that certainly had an effect on repair costs. But then repair costs are still pretty high, as Dr. Hart mentioned. Labor is there. Frequency of accidents was a kind of a shock to all of us. We expected that to, maybe it would go back to where it was, but it seemed to have exceeded to where we were anticipating it pre-pandemic. And then on top of all of that, we have the tech that's inside these cars, and I don't think that folks or even industry in industry have a real understanding of how that's going to affect the other pieces. It just seems to be, as cars become smarter, the idea is that it's going to reduce bodily injury, and there's reason to believe that is the case. But collision and liability property damage are going to continue to rise because we just don't know how all the systems are connected, and then finding folks who are able to fix them becomes more challenging, more expensive.
So I think you've hit upon another point there in terms of how to properly kind of think about what the future cycle of this market's going to be, because there are things that are constantly changing. Yeah. To your point, people don't want to go back to the Fred Flintstone mobile or the Model T. They like the new tech in their car, but it is obviously a price factor. And I think the other thing that obviously we've seen is the frequency and severity of storms that result in catastrophic losses and shows no signs of abatement. So those may be difficult factors in terms of understanding the future cycle of the market. George, I'll give you an opportunity to answer that question. Lee, I'll have a separate question for you, and then we'll check to see if we've got any questions online. Doesn't seem to have any yet, but I want to make sure that Dr. Hartwig is able to make his flight.
Sure. Well, I was a little bit heartened by what Bob had to say in predicting future trends, and also from talking to Lee a little bit beforehand, that because I was prepared for something on the order of the really down hard cycle markets that we have had, not recently, but that we've had in the past. And how do you deal with them? And the fact that all the legislature hears is from people how much their insurance is going up and what's going on, and no one, they don't have an answer to that other than the insurance companies are doing something wrong. And so I feel a little bit better having heard the presentation, and in terms of the timeline, that at least what I took from it, again, depending on the line of insurance and so forth, these factors that play are moderating. And Lee, I think you were pretty clear here and earlier that in terms of identifying areas where it's going to be tough, the market is going to continue to be tough, as you say. The auto market stands out in particular, and we'll just have to deal with that. But so I think this hope the legal system abuse was kind of interesting to hear about. I think we're in good shape, comparatively speaking, in New Hampshire. We really are, but still there are challenges. There's one bill I have to mention because it's taking up so much of our time right now that has to do with increases in wrongful death damages for consortium parent and child. They just killed the bill that would allow a pet to have damages for the death of an owner, or maybe the other way around, but wrongful death for pets.
I can't press that.
Exactly. So there's some of the stuff going on. Hopefully we'll be able to work that out.
Well, I set you up for that one earlier, George. I'm glad you got it.
Thank you.
Lee, from a consumer's perspective, what steps can they take? And as part of that, are some of the programs that some states have explored, the Safer Homes programs, are those something that may very well be useful to consumers?
I think there's going to be a move. There already is, but I think there's going to be a more prolific move into the loss prevention space. The IoT, the Internet of Things, the connections that your home can make to respond or give you notification about water leaks, about potentially frozen pipes, temperature change. That is, I think, where this goes to curtail future loss, right? We're going to figure out collectively, the insurance companies might be the Trojan horse for this to move it forward, but we're going to figure out how your homes become more connected and you avoid loss through this connectivity. I've sat through a lot of presentations lately on it. I think the pricing on some of these devices is still a little high, but not totally outside the realm. It's more the monitoring cost. So nobody likes, you have Netflix and all your other little here's another monitoring thing that's going to be in there. I'm not a huge advocate of that right now, and I think that's something that's going to have to get looked at very significantly. But I could see where insurance companies are going to offset those costs with credits. We're going to find a way collectively to avoid some loss, but also, work in tandem with the insured to, get it right. I had two other thoughts that occurred to me as we were talking, and they're both reinsurance related. I'm trying not to focus on that, but I think it just has a lot of tangential elements. So I'm going to throw out one thing, and I can't say this for every insurance company, but when you think about auto insurance, the types of losses that are experienced in auto insurance are generally not reinsurance. That is primary insurance. The limits are small. So they're net to the insurance company. So we don't have an additional expense, and we're still running horrible loss ratios, right? So just keep that in mind. There's no financial benefit for us to buy a contract through a reinsurer to offset anything. It's just going to hurt us. And the other element, and it's more of the homeowner side, is homeowners policies traditionally have an inflation guard endorsement. BOP policies, a lot of policies do, and they're very elevated. When reinsurance renewals happen, and most reinsurance renewals happen at the first of a year, not everybody, but I would say the vast majority of the marketplace buys on January 1, they're now buying at elevated inflationary adjusted homeowners costs. So I understand that the consumer is not loving the fact that their home value just got bumped up by, let's say 10%, because I think that's kind of the average right now. But the insurance company is also having to adjust for and buy reinsurance now based on a marketplace where there isn't as much capacity. So there's the reinsurers are kind of dictating a little more in the pricing terms because of these elevated values. But at the same time, the insured has to understand that we want to make sure you're insured to value on your home. If your home burns down and we have to come to you and say, you're going to be a couple $100,000 short, that is not a good feeling for anybody. It paints the whole industry in a bad light. So trying to make sure we get insurance to value on every risk we write, that's just part of the rigor today. It's the underpinnings of how the industry works.
Dr. Hartwig, any closing thoughts?
I've enjoyed listening to the panelists here and listening to your insights and your comments on all of this. One closing thought is almost the way that I began my closing slide is this industry has been through a lot. Record catastrophe losses, unanticipated inflation, a pandemic, collapse in financial markets. And it isn't the first time that this industry has been through those sorts of things. And if consumers take away one thing from all of this, what they should understand is that insurers understand that they have a commitment to them, each and every one of them. Hundreds of millions of policies, auto, home, small businesses large and small. And that the most important thing, and in fact the number one regulatory directive that you effectively have in every state. You mentioned, I can't remember the RSA or whatever you call it. Yeah. But in every state, insurers are required to be regulated in a way such that rates are not excessive, but they also cannot be inadequate. And the only way to make good on that promise over the long run is to make sure that the rates are adequate given the risk that they are assuming. Many other states have, I would say, given in with this idea that there's a way to suppress rates below the level that would be required given the risk that's being assumed, and that somehow there won't be an impact from that. What winds up happening in those states like Florida is the private market winds up first shrinking, potentially collapsing. The state creates a market of last resort, which provides kind of bad coverage at a price that still isn't adequate. It subjects the state to credit risk. So we see this, and then it winds up the state has to go through essentially a collapse in its market, like we've seen in Florida, essentially in California recently. And that's not how New Hampshire really wants to be. And from what I can see in this state, you've avoided that problem. But your counterparts in a couple of other states really have some lessons to learn. But they're oftentimes, very much beholden to the politics of their state.
Gentlemen, I want to thank you very much. This has been a fascinating and very, very enlightening conversation. We appreciate it very much. I'll end by saying that I've decided to make an executive decision that we're going to go ahead and do this again next year. We may very well turn this into an annual event. I think it's been worthwhile, as I said, to both consumers and folks who are in the industry. So again, thank you all very, very much. Thanks for the folks who are here. Thanks for the folks at